In our last lesson, we learned what a stock market is. Today, we're going to look at the historical record. We'll see that you can make a lot of money investing in stocks. We'll also see that there's no free lunch. If you want to try to make a lot of money, then you have to take some risks too. We also have to realize that investment advisors always include a disclaimer. I'm sure you've heard it before. Past performance is not necessarily indicative of future performance. We'll use some specific numbers to illustrate points, but the idea today is not to worry too much about those specific numbers. We want to get the big picture. What does the historical record say? Let's begin with the good news. It says that you can make a lot of money investing in stocks. If you had invested just $1 at the beginning of 1926 and reinvested all payouts such as dividends over the next 87 years, then you'd have done rather well. By the year 2013, a $1 investment in a broad portfolio of stocks would have been worth $2,843. Large company stocks wouldn't have done quite so well, but your $1 investment would still have turned into $2,103. The same investment in small stocks would have done remarkably better. Your $1 investment at the beginning of 1926 would have been worth $801,997. You'd have beaten the stuffing out of inflation too. To maintain the buying power of the $1 you invested, you'd need just $12.83 in the year 2013. You would have earned more than 222 times that by investing in a broad portfolio of stocks. The main story that you can make a lot of money investing in stocks doesn't change much if we look at different selections of stocks according to characteristics like size. Sure, small stocks beat large stocks over the period from 1926 to 2012, but you would have made a lot of money in either asset class. The main story doesn't change much if we spread our investment equally among all companies, or if we had invested more in big companies than we did in small ones. You'll find differences by industry, of course, especially for relatively short periods. Sometimes financial stocks will do better than energy stocks, which might in turn beat transportation stocks. And sometimes transportation stocks will do better than financial stocks and energy stocks. But for the most part, the historical record seems to say that you just need to get into the market and stay there for a long time. I'll bet you know what's coming next, don't you? I'm going to change just one single word. I'm going to change make to lose. You might find that hard to believe by looking at stock returns over very long periods, and in some sense, you're right. The historical record does suggest that you can recover any losses in stocks if you stay in the market long enough. You'd have gotten absolutely hammered if you had needed the money from your 1928 investment at the beginning of 1933. You would have lost about 2/3 of your initial stake. True, your investment would have recovered almost all of the losses by 1936 or so, but you wouldn't have gotten back to the break-even point permanently until 1943. That's about 15 years. That's 15 years before you do much better than just break even, and even at that, we've ignored inflation. For most people, 15 years is a long time to have your portfolio be underwater. Would you have had the stomach to tough it out for that long, or would you have thrown up your hands and gotten out of the market somewhere along the way? What's more, I'm going to say the same thing that I said about the story not changing much if we look at different selections of stocks according to characteristics like size. You would have lost less in big companies, and you would have recovered a little sooner too. But it would still have been a rough ride for 10 years or so. And just like when we looked at the happier side of the story, the main point that you can lose a lot of money investing in stocks isn't going to change if you look at different industries, especially for relatively short periods. Just how good is a good year for stocks? And just how bad is a bad year? The answer to the good part is really, really good. Sadly, the answer to the bad part is really, really bad. You might want to sit down for this next part. Between the years 1926 and 2012, the best year return was in 1933, which checked in at almost 58%. The worst one-year return was in 1931, a loss of almost half, over 44.4%. Now, don't make the mistake of thinking that the downside is less damaging than the upside. If you start with $100 and suffer a 50% loss, then you have $50. It takes a gain of about 100% to make up for that 50% loss. What these numbers tell us is that the worst year and the best year are reasonably similar in the sense that they pretty much cancel each other out. Looking at historical rates of return over different time horizons tends to make people think that the longer you stay invested, then the safer you'll be. For example, from 1926 to 2012, one-year returns vary from a loss of about 44% to a gain of about 58%. For two-year returns, that range narrows to a loss of about 37% to a gain of about 38%. For 10 years, the range is from about a 2% loss to a gain of about 19%. For 50 years, the range is from a gain of about 7.4% to a gain of just over 13%. For 75 years, you can say that the rate of return is right around 10%, whether you have a good 75 years or a bad 75 years. The range is only from 9.4% to 11.7%. Lots of people interpret this as showing that the longer you stay in the market, the safer you'll be. Many of you have seen this idea promoted before, and if you haven't, then I'd bet you will soon. But the argument is simply wrong. The longer you stay in the market, the more risk you bear, not less. Yes, the range of potential rates of return does narrow over time, but the range of potential payoffs in dollars doesn't. The longer you're in the market, the bigger the potential losses and gains in dollar terms. And you buy things with dollars, not rates of return. Does it sound strange that even as the rates of return tend to even out over time, your dollar values don't? Most people think it does, but that's just the way it works. The intuition is that as the rates converge with time, you may miss by less each period, but you miss for a longer time period. Let's use an analogy that's more familiar to us. Suppose that you and your friend Lisa each take a car and set out on a long road trip. Lisa averages 60 miles per hour for the first hour, but you only average 50. After the first hour, you're 10 miles behind. Now suppose that during the second hour, both you and Lisa average 60 miles per hour. Lisa is still averaging 60 miles per hour, and now that you've covered another 60 miles to go with your previous 50, you've pulled your average up to 55. But you're still 10 miles behind Lisa. Think of it this way. Instead of falling 10 miles behind in 1 hour, you fell behind by an average of 5 miles per hour for 2 hours. You're in the same place relative to Lisa, either way you think of it. If you had averaged 58 miles per hour during the second hour instead of 60, then you would have lost another 2 miles and been 12 miles behind instead of 10. But the difference between your average speed and Lisa's average speed would still have narrowed, even though you lost more ground. Instead of 60 miles per hour for Lisa and 50 miles per hour for you after 1 hour, it'd be 60 for Lisa and 54 for you. You gain in terms of average speeds, but you lose in terms of miles because you lost ground for 2 hours instead of just 1. It's the same for rates of return. Suppose that the expected return on stocks averages 10% per year, but in your first year you earn 0. That's bad. You're 10% below the average annual return. Now let's suppose that next year you do get the average return of 10%. Your 2-year average is 5%, which is much closer to the true average of 10%, than the 0 you had for your first year. But you didn't gain a thing relative to the average during that second year. You just held your ground. Instead of falling 10% behind in 1 year, you fell 10% behind over 2 years, or an average of 5% for each of those 2 years. You're pretty much in the same place relative to the 10% average either way. The point is that rates of return and dollars earned are like miles per hour and miles traveled. You may miss the target by less each period, but because you miss for a longer time period, you can fall farther behind. What does this mean for the historical record of dollar values for investing in stocks? I'm willing to bet that you haven't seen the historical record for dollar values before, so let's take a look now. Sure enough, even though the range for the rates of return narrows with longer holding periods, the range of dollar values at the end of the holding period widens. If you start with an investment of $10,000, then you'd have just under $57,000 after the best 10 consecutive years during the sample period. That's about a 19% return each year. You'd lose a bit on average during the worst 10 consecutive years during the sample period, and you'd only have about $8,100 afterward. That 21% difference between the best and the worst period turns into a $49,000 difference, or almost 5 times your original investment. Over a 50-year horizon, when we know that the range of rates of return really has settled down quite a bit, the range of dollar values has nevertheless exploded. The worst 50-year period returned 7.4% annually, which would leave you with about $360,000. The best 50 years? That featured an annual return of 13.2%. What does that 5.8% per year mean in dollars? How does over $4.5 million sound? Yes, really. Even though the difference between the best rate of return and the worst rate of return narrowed from about 21% over the 10 years to less than 6% over 50 years, the best 50 years of stock performance would give you almost 14 times what the worst 50 years would give you. The 5.8% annual return differential really makes a difference over 50 years, doesn't it? Let's look at a 75-year horizon just to hammer home the point. Over the period from 1926 to 2012, the best 75-year period yielded an 11.7% annual return. The worst 75-year period wasn't far behind at 9.4%. That's just over 2 percentage points from best to worst. The range of rates of return has really shrunk. But how much difference in dollars can such small differences in rates of return make on a $10,000 investment? The answer may surprise you. It's almost $33 million. No, 2 percentage points isn't very much of a difference, but 75 years is a very long time. That small difference in rates of return makes a big, big difference in money earned over 75 years. Many of you have heard that a very large proportion of stock market gains over a long period of time occur on just a few days. That is absolutely true. Goldman Sachs looked at the 20-year period from 1993 through 2012. If you were invested for all 5,037 trading days during that period, then you would have earned an annual return of 8.23%. Not bad. What would you have had if you had missed the best 10 days of those 5,037 days? Your annual return would have dropped almost in half to just 4.54%. And if you had missed the best 40 days, that's less than 2 trading days per year, then your annual return would have been a negative 1.95%. The moral to the story is that the conventional wisdom is correct. You really can't make much money if you miss the handful of the best days of the year. You are much less likely to have the financial media show you the other side of the coin, though. Keep in mind that if you're going to stay invested so you enjoy the good days, you're going to encounter bad days too. Just how bad are the bad days? Bradford Cornell of the California Institute of Technology used data from the Center for Research and Security Prices to study the best and worst days on the New York and American stock exchanges and the NASDAQ system from 1988 to 2012. As you might suspect, he found some absolutely enormous market moves. The biggest one-day move up or down occurred on Monday, October 13, 2008, when governments around the world said they'd help to bail out financially stressed banks. Stocks jumped 11.49% in one day. The second biggest move was also an up move, and it was just about 2 weeks later. On Tuesday, October 28, 2008, stocks jumped 9.53%. Cornell reports that nobody had a really good reason for that move either, saying that the day's rebound in stocks defies latest economic news. This fits with the oft-repeated idea that stock investors just can't afford to be out of the market on the good days, and I'm not going to disagree. What I am going to do is give you the rest of the story. Yes, the two biggest market moves from 1988 through 2012 were gains, but the next 5 most extreme market reactions were losses. Even the best of these bad days resulted in a loss of over 7%. And the worst of the worst would have cost you just a shade under 9% of your money in just one trading day. Of the 50 most extreme days, 22 were positive and 28 were negative, and the average of those 50 days is a loss of about 0.75%. Remember the conventional wisdom? It says you can't make much money if you miss the handful of best days of the year. That is absolutely true. Just remember the rest of the story. You're going to experience some horrible days too. Hey, there's no free lunch, folks. Stocks offer the opportunity to make some serious gains, but with that comes the chance to take some serious losses. You might be wondering what made stock prices move so much on these extreme days. That is a very difficult question. We know that the value of a stock depends on just 3 things. First, there's how much money you expect to get from the stock. The more money you get, the more valuable the stock. Second, there's how long you expect to have to wait to get it. The longer you have to wait, the less valuable the stock. And third, there's the interest rate during the time you're waiting. The higher the interest rate, the less valuable the stock. The idea here is that if you had the money now, then you could invest it and earn interest on it. And you can make a lot of money if interest rates are high. That means that having to wait for the stock to pay off really hurts when rates are high. So the stock is worth less. Because those 3 things are what determines the value of a stock, that means that stock prices should only move if we get some news that changes the market's perception of them. Either the market expects a change in the amount of cash the stock will provide, or when it will provide that cash, or the cost of waiting to get that cash. If there's no news, then not much is going to happen. The idea that news makes stock prices move isn't very satisfying, is it? You want to know what actually constitutes news, don't you? That is a tough problem. We do know that it's wrong to confuse information with news. For example, nobody believes that the information that Ohio became the 17th state on March 1st, 1803 is the type of news that will move stock prices today. That news is over 200 years old. Whatever effect it may have had on stock prices way back then, it's long been incorporated into the stock price. Events in the past aren't the only thing that can count as old news and which therefore shouldn't affect stock prices. We have to allow for the fact that important market players may have already expected it. Some of you are old enough to remember Don Meredith, one of the members of the original broadcast team of Monday Night Football. After an important play that clinched the victory, but before the game was actually over, Dandy Don would break into song, singing, "Turn out the lights, the party's over." The rest of the game was just a formality. Fans of the losing team would start streaming for the exits before the final gun officially ended the game. The final gun didn't make the losers any sadder than they already were, because they already knew they were going to lose. By that time, they fully expected the result, so the result itself wasn't news. That happens in stock markets too. If we know something bad is sure to happen, then when it happens, it isn't news. Brad Cornell gives the example of the federal government seizing Fannie Mae and Freddie Mac in early September 2008. On its face, that should have been a huge event. After all, just Fannie Mae alone reported that in August 2008, it had issued or guaranteed over $3 trillion worth of mortgages, and just a few months earlier, politicians and regulators had been telling the world that Fannie and Freddie were just fine. Yet the market return on the day of the government seizure doesn't make the list of the top 50 most extreme market moves. Why not? The answer is that most important market players were already convinced that Fannie and Freddie were zombie institutions at the time, and that a federal takeover was just a matter of when, not if. By the time the seizure actually happened, it wasn't really news. We still have a lot to learn about what makes stock prices move. Specifically, we'd all like to know more about the kind of news that changes the market's perception of stock values. Way back in 1989, economists David Cutler, James Poterba, and Lawrence Summers tried to find the cause of the 50 largest one-day market moves on the S&P 500 index from 1946 through 1987. They reported that they just couldn't do it for a lot of those 50. Many times they just couldn't find any good reason why any of the things that determine a stock's value might have changed. Not future profits, which are an estimate of what we're calling the amount of cash the stock will provide. Not when the stock will provide that cash. Not even the cost of waiting for that cash. Nothing. In 2012, Bradford Cornell found pretty much the same thing. He wrote, "Despite the explosion in information technology, enhanced market regulation, innovation in stock trading, and the introduction of new equity-related financial products, large movements in the market remain as common and mysterious as ever." Cornell could only find economic news that could have had a substantial effect on the forces that drive stock prices in a minority of the 50 largest moves from 1988 through 2012. In fact, Cornell found that the explanations the media pundits usually trotted out sounded reasonable, but didn't really explain anything. We've all heard statements like, "The market fell today as shares were pressured by increased selling." But there was a buyer for every seller. Why didn't the market rise? Because of the increased buying. If the market had gone up, then the media guy would have said the same thing, except he'd change selling to buying. This type of purported explanation doesn't help me understand what makes stock prices move. It sounds a lot like being the parent of a teenager. If you're the parent of a teenager, you understand that sometimes your child's behavior defies explanation. Your friend will ask, "Why did she do that?" All you can do is shrug your shoulders, throw up your hands, and say, "She's a teenager." Your friend will smile and nod her head as if being a teenager somehow explains things. You can explain anything a teenager does by saying, "She's a teenager." But it really doesn't explain anything. It doesn't tell us how to shape our child's behavior so that she doesn't do the same dumb things that we did when we were her age. We need to understand a lot more about how human beings respond to social pressures, hormonal changes, aspirations, and insecurities. "She's a teenager" sounds so much better than "I have no idea." Have you ever noticed that the financial media explains stock market behavior the same way? On days when there isn't any economic news that could have caused a big price change, the financial media typically fall back on unverifiable psychological factors that really amount to throwing up their hands and saying, the stock market is a teenager. For instance, on August 31st, 1998, the 13th most extreme market move during the period from 1988 through 2012, the financial media attributed the 6.6% drop in stock prices to fears of turmoil in Russia and doubts about Asia. Blaming something on fear or doubts doesn't help. You can always blame a decline on things like that. And you can always attribute an increase to optimism. I want to know what caused the fear. What caused the doubts? What news do we have today that we didn't have yesterday? The lesson here is that attributing stock price moves to psychological factors isn't getting at the underlying reason for the price change. That means that we really don't understand the reason for the price change. We simply don't know everything about why stock prices move. We do know quite a bit, though. If you tell me that the market moved a lot today, then I'm betting that it'll move a lot tomorrow, too. Mind you, I don't know whether it'll move up or down, but I do know that volatile days tend to group together, and so do tranquil days. In this sense, market volatility is like the weather. If I asked you to guess the high temperature in New York tomorrow, your best guess is a little over 60 degrees. That's because over all 365 days, the average high temperature in New York is a bit over 60 degrees. If you're watching in July and today's high is 84, though, a better guess for tomorrow's temperature is the low 80s. And anyone who's been in New York in January knows that a guess in the 30s is more likely to be much more accurate in January. In fact, a good guess of tomorrow's high temperature is today's high temperature. If it's 85 degrees today, then the odds are pretty good that we can rule out temperatures in the 30s or 40s or 50s. High temperatures, and low temperatures for that matter, tend to cluster as weather systems form and dissipate. Market volatility is a lot like that. Highly volatile days tend to cluster with other volatile days, and calm days tend to cluster with other calm days. Here is the historical evidence. During the 25 years from 1988 to 2012, almost half of the 50 largest stock price movements occurred in just 1 year, 2008. 24 of the 50, to be exact, including the 7 largest. Just 2 of those 25 years, 2008 and 2009, produced 9 of the 10 most extreme market moves. If the big moves were distributed randomly throughout those 25 years, then you'd expect to have less than 1 of the top 10 in any 2 years. Yet 2008 and 2009 had 9 of the 10. Extreme moves seem to clump together. What's the point? Remember, when you hold stocks, you're holding risky assets that offer a particular mix of risk and expected return. Volatility clustering means that sometimes you're getting more or maybe less risk than you bargained for. That means you might want to increase your equity stake in periods of calm or take a little money off the table during unsettled periods. Notice that I'm not saying you should do this. I'm saying that it's absolutely normal to feel a little nervous during these volatile periods, and you might want to think about adjusting your portfolio if you're uncomfortable with how volatile the market happens to be. It has nothing to do with prices being too high or too low. It's the amount of risk you're taking that might motivate you to take action. If you do decide that you want to adjust your equity position depending on current volatility, be sure to be honest with yourself. We saw the historical record, right? Sometimes we saw big moves down, and sometimes we saw big moves up. Big moves up signal risk just as much as big moves down. Lots of people find it hard to take some money off the table when things seem to be going their way. That's okay. I believe that prices are pretty close to fair during periods of high risk, so you'll likely get fair value if you sell during periods of high volatility. If you do it, just do it with your eyes open. In our next lesson, we'll try to understand and answer an investment advisor's favorite question. Do you want to eat well or do you want to sleep well? We'll learn more about the trade-off between the amount of risk you take and the amount of money you can expect to make. We'll also learn about diversification. That's about the closest thing to a free lunch you'll find anywhere.